All right, switching gears from one bubble or micro bubble to possibly another, we'll see. Let's talk about the bubble of interest surrounding the scheduled Facebook IPO later this month. Look at this. Here's the coffee sleeve from JP Morgan, one of Facebook's underwriters for the IPO. That's very cute. Now, the company's expected to kick off the roadshow Monday for its initial public offering, which is scheduled later this month, mid-May. Now, it's setting an IPO price range that values the company for as much as $96 billion. That is a pretty penny. Facebook's operating income, just for the perspective, was $1.7 billion last year for 2011. Quite a difference. So the question is if it's worth it. We're going to bring in Reggie Middleton because he has been following this. So I'm really interested to get his perspective. Reggie, let's bring you back in. This $96 billion valuation for Facebook, do you think it's worth it, or do you think this is just a pump and dump and the average investor is going to get the backwash that's left in these IPO markets?
Well, of course it's worth it. I mean, how could you say it's not worth it? Mark Zuckerberg becomes an instant multi-billionaire. You know, it's worth it for Mark Zuckerberg.
Worth it for him.
Now whether it's worth it, now whether it's worth it for anybody who would buy it from these underwriters, of course not from my perspective. You know, 99 times earnings roughly is the high end of this. And we're talking about a brand new company that's in business that has had several companies flame out, going against companies that are growing just as fast or faster with more experienced management, larger infrastructure, more capital, more reach, more products, everything. And I'm not saying that Facebook won't make it, but you know, there's a lot going against them, and you don't put a 99 times valuation on earnings. Now, of course, with fast-growing companies, lots of people say, well, you can't necessarily go on PE with startups instead of a Facebook. Is not a startup, though. But no matter what metric you use, price to sales, price to earnings, enterprise value, cash flow, Facebook is grossly overvalued at what the underwriters are trying to push it at. On top of it, even as a fast growth company, if you take a look at the metrics that were published, their growth is slowing down. It slowed throughout 2011. It's actually on a downtrend. And then you're going to buy an IPO at 99 times PE or any other metric with slowing earnings and slowing sales growth. And then there's a corporate governance issue. You have Mark Zuckerberg, who apparently allegedly created Facebook. Seems like a very bright guy, apparently a decent enough leader. He brought Facebook to where it is now, but he controls 56% of the voting stock. So here you have what can be considered a young guy, inexperienced guy in his 20s, first time running a public company, first time running a company of this size, first time running a social networking entity of this magnitude of capability, who controls 56% of voting stock. Exactly what are you getting for your money? I make $100, I make $1,000, and I say I want you to give me $100,000. For my $1,000 of earnings. And in exchange for that, I'm going to control more than half the company.
Yeah, that's...
What are you getting for your money?
Yeah, that doesn't seem like a very fair trade-off. So then my question for you, Reggie, what is all of the interest in this about? How much of a role does the lack of interest in other IPOs have to do with it? And also the marketability of Facebook for average people that say, oh, hey, I like this company, I love it, I use it, millions of people use it, so I want to own it.
Well, there are two things. Number one, it's a very good story stock. If you remember the story stocks from the dot-com days, a lot of the companies told very good stories, from Bikini.com, self-explanatory, to a lot of other companies. But what makes Facebook a very good story stock is, even though it deals in intangibles, it's an internet company, it has a tangible story because almost everybody or at least some of the people actually use Facebook, have a Facebook account. So they're familiar with it, they use it. But most of the people who use Facebook, just take yourself. How much money have you given Facebook over the past year?
None, Reggie. I am not even on Facebook.
And that makes it even worse. But most people don't spend much money on Facebook, and that was, and the fact that you're not on Facebook speaks volumes. Now, outside of being a good story stock, right, which really helps, they have some of the best salespeople in the industry. Goldman Sachs, Morgan Stanley, JP Morgan. They are expert salespeople. So you take a good story stock, you give it to a very, very good salesperson, and what do you have? You create froth. Okay. Now, froth and investment potential are not necessarily the same thing. I'm sure there's going to be a big pop at the IPO. Okay, after that pop, it's going down. When it goes down is a timing issue. I'm not a trader, but the fundamentals simply are not there.
With the frothiness,
not at the prices that they're offering it.
Okay, and with the frothiness that you just pointed to, and the history which you alluded to, I didn't realize that bikini.com was such a big hit. Thanks for that bit of history. But is this part of any bigger trend? We've seen some other tech IPOs in the last year, LinkedIn, and also some others that are escaping me.
Well, there is a trend. I think most of the dot-coms had frothy valuations, especially considering the business model, revenues, profits, et cetera. When Groupon filed for a public IPO, I told my subscribers it was absolutely ludicrous, easily going at 100% of what it's worth, easily. Groupon dropped to less than 50% and was offered that, simply because the business model was not sustainable, it was not there. But it had a .com on it. Same thing with many other .coms. You had a Zigna, et cetera. Basically, the internet bubble is back. And it's back, big time, considering the fact that at least the last time we had the internet bubble, you had general economic strength and growth. Right now, you have weakness globally, and you have these stocks that are being pitched at, ridiculous valuations. Again, Facebook is an interesting story. It has a chance. From a speculative point of view, it's worthwhile. Just nowhere near the offering price. At the offering price is more than speculation. If I have $5 or if I had $2, I go one to the lotto, one to Facebook.
Yeah.
And,
you don't know what your chances are going to be better with.
Have a larger return.
Yeah, Reggie, before we go, we just have
depends on what country, depends what city. So.
Yeah, Reggie, we just have a minute left.
It pays off more.
We just have a minute left, but I just want to ask you, you say this is an internet bubble, a tech bubble redux. What would it take for the bubble to pop? You say that there's no growth now, unlike back in the day. So what could the impact of that be?
Well, I think that fundamental investors have been severely compromised and damaged by the central banks. Free liquidity, freely distributed liquidity, free money, zero negative interest rates, basically destroy market pricing. When you destroy market pricing, fundamental analysis doesn't work. Now, there's some newbies who feel that fundamental analysis doesn't work in general, but that's nonsense. What fundamental analysis is counting money. You open up a bank account, you put $10 in, you add $2 more on the following day. Fundamental analysis says you have $12 in that bank account plus whatever accrued interest. And that's what it is. If you use free money and negative interest rates and liquidity that's given away for free, then you simply cannot count the money, because now you have negative interest rates. You have things that simply don't happen in a normally functioning market. That is unsustainable. It's never worked over the intermediate term. So once market pricing returns, these bubbles will go bust. You would not be able to launch Facebook at 99 times earnings, because most people wouldn't want to buy it, because they have to pay for their money. They'd be accountable for the money. Well, when you have negative interest rates and free capital, then it's your money, it's not my money I'm spending, so I don't care if I lose it.
Well, it seems like that is going to end when the Fed packs up and ships out and stops flooding the money with market with liquidity or keeping interest rates at zero. We'll have to wait for that day, but we'll keep talking about it. Reggie Middleton, thanks for being on the show. He's entrepreneurial investor and has Boom Bust blog.